Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive right in, take a look, see what's going on today. And if you want to follow me, it's at Finance. If you want to join our community, finding-value.com, where I dive deeper into all these sectors, looking for potential investment opportunities, sharing those opportunities with everybody in the community. And I do it from more of a teaching mentor relationship, I would say, less so of this is good and this is bad. I kind of give you the background and reasoning of why I think things look good, and you can learn for yourself on how to approach the markets, at least through the approach and strategies that I use. If that sounds interesting to you, you can sign up using special as a coupon code and get further savings. It ends up being $25 only for the first month, only on the monthly membership. Only the first month is $25. And then the $100 discount applies to the yearly membership, where you can swap either from a monthly to the yearly or directly into the yearly, which ends up being about $500 a year. So going down into Larry Thompson, he says XME, which is the miners ETF, versus XLE, which is the energy ETF. And he says 20-year base breakout. 20-year base breakout, in his opinion. What I did, this is a ratio. This isn't like a price movement thing. As I put XLE divided by XME, and sometimes you want to flip these over. And I don't know if this is a 20-year breakout here. Usually on breakouts, you don't get wicks like this. See where it kind of breaks out and then it gets bought back up. I don't know if this is a 20-year base breakout. I think this is going to be ending up being a bottom here. And I think this is going to go up this way, where XLE is going to outperform XME potentially. Now, one thing, if you're claiming to see this, we should see a gigantic breakout on XME, and we do. There's the gigantic breakout on XME to get you that ratio difference. And again, this is XME priced in dollars. Falling wedge, double bottom, breakout. Sometimes you get a pause retest in this section here, and then we have a big run. We can look at XLE, and that's priced there. For XLE is the State Street Energy Select Spider ETF. What do I see here? I see about a massive breakout is about to occur to the upside. So if I were to guess at what the ratio is going to do, I would guess that XLE is about to break to the upside and go all the way up. So that would mean that the XLE divided by XME ratio is probably bottoming. That would be my guess. Not saying I have all the answers, but that would be my guess of what's happening. Also, if you look at this ratio and what it looks like, I think that this was probably a base that we came up. Could this be some sort of like wave one, wave two bottom, and then we're going to rip all the way up? Could be. Could be. I don't know if it is, but it looks very similar to something like that. So that's what I think is going to happen there between those two. So I am in exact opposite contrast to Larry Thompson here. He says 20-year base breakout. I'm looking at it as a ratio. I think this is actually going to drop back down. We'll see who's right. Remember, gold is at a very high ratio in relationship to oil. Oil is very, very cheap. So what he's stating is that the relationship is going to break out and move. I find that a little bit difficult with how cheap oil is and the potential that you have in the oil equities. So I think we're going to break back down. That's me. We'll see who's right. John Kemp says LNG promotes convergence of Atlantic gas prices. The benchmark gas future prices are beginning to converge as record volumes of liquefied natural gas flow across the North Atlantic, reducing excess inventories in North America and relieving shortfalls in Europe. The partial integration of the two formerly separate regional markets is being realized as the build out of liquefaction export terminals in North America and regasification import facilities in Europe reaches a critical scale. So we've got US and European gas futures. He is proposing that these are going to converge. This will come down while Henry Hub goes up. That could be the case. That could be the case. But also, I want to see how much natural gas America's really got. Let's see what occurs over the next year or two and see how much production we can produce in terms of nat gas in America. Because as this converges, it's going to want to ship it all out. Now, if we ship it all out, let's see what the weather does. Let's see where prices go. And if we've got enough production to kind of mate these two together at a low price. If we don't have enough production, these will both go up. If we do have enough production, at least in the short term, we could go sideways for a little bit. And then I'm curious to see past 2026 what occurs. I really am curious. Market Sniper going after the Henrik Zaberg. Henrik says gold is about to fall over the cliff in a very big way. The inflation coming narrative cannot hold it longer. Long and strong decline coming, in his opinion. So that's what Henrik Zaberg, and he's basing this off the relative strength indicator, making a lower high than this. And we've pulled on back. We've got Market Sniper, Francis Hunt, chiming in. He says the RSI indicator trading is for technical analysis newbies and college kids. First third of the chart, see the number of RSI highs with pullbacks on gold running into its all-time high. None of the RSI highs were sell signals on any reasonable time frame. Price is the dog, indicator is the tail. The mechanism is whatever price-based math formula you want, which will time lag. The tail wags because the dog is happy to see you, not because the tail is specifically happy. You become what you focus on. Don't stare at tails. You will always be late. In Francis Hunt. And that's what he's saying here. And you can see RSI wiggling back and forth as the price goes up. We had a nice little consolidation, potentially even a cup and handle maybe if we break to the upside. He's saying down. Francis Hunt says don't focus on RSI. You're looking at the wrong crap. This always happens in technical analysis, right? What about interest rates? Now, could we go down in the short term? Yeah, we could. Does it matter? No, it doesn't matter. It doesn't matter, guys. Longer term, we're going up. Why am I so confident? Go look at Japanese bonds. Go look at those interest rates. In fact, let's go look at the Japanese. Let's JPY. I think it's the 10. No, it's JP 10-year. That's what it is. This is government bond yields. Look at the yields on Japanese government bonds. Just going vertical. Going vertical, goose. Ripping higher. And that's a double bottom there. You can see the double bottom. This is a good time to go long on yields, so to speak. And I think that's what's going to happen to the US 10-year too. I really do. The US 10-year looks like it's coiling up for potential move higher, not lower, higher. Now, could we get a false breakdown before it occurs? It could. We can get washout sales. I'm not saying that I know the future here. But, they're going at it. And gold, gold could go up with interest rates. That's what happened in the 1970s. Gold and silver. Silver goes up with interest rates too. So we'll see. Platinum goes up with interest rates as well. Let's see what platinum's doing against gold. And I think we're going to break out of this to the upside. I think platinum's going to outperform gold here at some point. Got a nice little flag pattern going on. It's looking good and consolidating in a big flag pattern here. There's the flag and a flag within a flag. How about that? We're flagging to the flags. Yeah, I think this is going to break out on the ratio and go all the way to some level, maybe all the way back up here. If that's the case, platinum is going to do some serious moving. Now, just because I say that doesn't mean that I change my approach. I know a lot of people, they're asking, should I swap silver to platinum? And it's like, I don't know, guys. Silver looks pretty dang good. We're breaking out of this 50-year cup and handle. I like this. I like it a lot, is what I'll say. So I personally, I probably wouldn't. Does this look more like the beginning of a brand new uptrend for Palladium or the end of one? It's the beginning of one. It is the beginning of one, Goose. And in fact, if you were to chart it the way that I look at things, it's a falling wedge right there into a double bottom, and we've broken out of the double bottom and heading higher. So yeah, I'm in agreement that this is the beginning of an upward move trend. Looks very good to move higher, longer term. So yeah, I agree with them. Upward. Nice little arrow there. Global power demand is set to rise 30% over the next decade. That's roughly 1,000 gigawatt increase. 1,000, guys. To put this into perspective, this is what you need. 980 nuclear reactors covering 1.5 kilometers squared. We need 2,568 gas power plants covering 257 kilometers squared. 1 million wind turbines covering 1 million kilometers squared. 12.5 billion solar panels covering 70,000 kilometers squared. It says, and that's just to cover demand growth. Renewables would also require massive infrastructure investments and batteries, which in turn would demand even more wind turbines and solar panels just to charge them. It's no surprise that data center providers are turning to gas and nuclear. Even those data centers that supposedly run on renewables are still connected to the grid, meaning they draw from the same power mix as everyone else. They simply buy certificates, get a green label, and qualify for subsidies, or to meet ESG mandates required by institutional investors. So global power demand is set to rise 30% in the next decade. Data center use to grow to 3.5% of total from 1.5%. And this is the terawatt hours: industry, residential, transport, commercial, and public services, data centers, and other. Look at the back. I mean, look at this growth here. 1,000 gigawatt increase. That's so much. 1,000 gigawatts. Wow. Coming down, we've got $300,000 a year. So he says, Merry Christmas. We live in a period where $300,000 a year is poor, not middle class, poor. This is about to get worse, as we've been saying, blah, blah, blah. And I agree, $300,000 a year is not poor. I'm sorry, guys. $300,000 a year with no financial discipline and reckless lifestyle is poor. It's 300,000. You're in the top few percent if you make that amount of money. It is not poor. Steve says, pick one. A paid off $5 million home or $3 million in investments. Stipulation, you can't sell either for at least 5 years. I need further information. A paid off $5 million home. What is the property taxes and where does this home locate? A $3 million in investments. Do I get to choose the investments, or is the investments in bonds or in the S&P 500? Because this is going to change my opinion and what I would choose drastically. If they stipulated that I had a $5 million home in a low tax state with low property taxes, okay, I get it. And if they said 3 million in bonds, I would choose the house. If they said 3 million in S&P 500 and I have to hold it for 5 years, I choose a paid off $5 million home in a low property tax state with low income taxes. I would choose that. Now, if I get to choose my 3 million investments and I get to choose where I want to put it, I would probably choose the $3 million investments, and the $5 million home would probably get overrun. I would choose this perhaps. Maybe. It depends where the $5 million home is, and it depends on what it looks like and where it's located. So if it's in a very nice area with low property taxes, good schools, good clean drinking water and all that stuff, I may choose the house. Maybe. It highly depends on what the costs are for the home. Now, if I get to choose my 3 million in investments, I may choose the investments if I don't like where the home is located. So, I mean, it really depends on what's going on. Because remember, a 5 million today is 3 million in investments isn't guaranteed. 5 million, I mean, that's home prices are usually pretty stable. So, I mean, a $5 million house, that's a lot of money. That's a big home. Uh, More than likely, I would probably choose the 3 million in investments if I get to choose where they go, because I don't need a $5 million home. Let's get real. Uh, my wife would be like, I don't want to clean this crap. I'm like, yeah, me either. So, but what we'll see. It would depend. Many finance bros say, don't max out your 401k, just get the match. You can't you can't early retire with a 401k. But that's wrong because you have the rule of 55. Can't pull at 55 if you quit your job. You can pull, I mean. The 72T plan can pull at any time with a plan. And then the Roth conversion ladder, max your 401k in his opinion. What I do, I max it. I max it out, and then I also have money on the side to retire whenever I want. So I do both. It's not one or the other. So I max pre-tax a 401k. I max backdoor Roth it. I max that. I max the Roth IRA. The Roth IRA by doing a backdoor Roth conversion from a traditional IRA, and I put a whole bunch outside of it. I do everything. But when I was younger, I couldn't do that. So I tried to put as much as I could in wherever I could when I was a lot younger. And then most of it went into a 401k tax shielded. So as you build wealth, as you build dividend income, as you build and build and build, which takes some years. Remember, I've been investing for over 20 years now. So if you do it early and you stack it in the beginning of your life, you're going to have a whole bunch of options later on. It takes time, not stating it doesn't. It's really boring in the beginning. And I just keep going. I just keep going. I keep reinvesting in dividends, reinvesting whatever I can. I invest new stuff. I do all sorts of stuff. And this is what a new parabolic uptrend looks like. Gold versus the S&P 500. It's breaking out. This was the last big bull run from the early 2000s into the early 2010s. We had a pullback, double bottom, and we're breaking out of the double bottom here. Lead-in pattern, double bottom, and breakout. New parabolic uptrend looks like. Bam. Your commodity bull market is engaged. The older I get, the more I realize this. Let's hear what you have to say, Kenny. He says, a $100,000 Mercedes and a $10,000 Toyota will drive you to the same place. A $1 million mansion and a $100,000 house will give you the same sleep. A $50,000 Rolex and a $100 watch will show the same time. Happiness is not found in things. You are correct, Kenny. You are correct. Now, there are some things on the outer edges that do matter, like a really nice bed. Get a really nice bed. Get a really nice pillow, one that like absorbs some of the heat and conforms to your head and neck. Even if you have to pay $10 more for it, that's where the money counts. That will impact your sleep. It won't be the same sleep. It will be better sleep. So a really nice bed, really nice pillow, that's where I would spend the money. But in all honesty, You can find cheap solutions for beds that feel really nice. You really do. I bought a bed a little while ago, and it is so comfortable. It's a hybrid mattress with springs at the bottom and a soft, kind of a little bit of a softer top. One of those conforms to your body and supports. It's pretty nice. I'll admit it. Now, I didn't spend a lot of money on it though. I spent like 300-400 bucks on a king size mattress. You know I'm finding value. You know I'm where I'm at with my head. Here's John. He says, if you aren't happy having $100,000, you're not going to be happy if you have 100 million. Happiness isn't found in money, is what he's saying. Happiness isn't found. So even if you start making all this money, you better find happiness somewhere else because you're not going to find it in money. But I will say, not having money can put a lot of stress on somebody. So I think having a certain amount of money is good, and then having exorbitant amounts of it may not change your happiness all that much. Great Marti, he's coming out. U.S. oil breaks out, copper breaks out, natural gas parabola. Inflation under control, smiling with some sweating. A major equity sell-off is the temporary solution. 1970s vibes are getting louder. So he's got U.S. oil trying to break out here, this falling wedge in a very short-term pattern. Maybe we break in oil, maybe we don't. We'll see. I'm remaining open. Natural gas going parabolic, and then copper breaking out. So let me ask you this question. When we break these patterns, if this is a true breakout, if it is, so if oil breaks out and copper breaks out and natural gas is going vertical, can someone tell me if this is a recession signal? Crickets, I hear crickets, nothing. So does this seem bearish to you? Just asking for a friend. And again, this is I went over that last time, so that's where we're going to end it. Give me a thumb up for the content. Subscribe to the channel, subscribe to the website, specials coupon code, and that's all I've got. So we'll catch you next time. See you later.